IAS 8 Accounting Policies. Changes in accounting estimates and errors establishes the principles governing the preparation and consistency of financial statements. The standard aims to enhance comparability and reliability by ensuring that entities apply accounting policies consistently and correct errors appropriately. IAS 8 addresses the selection and application of accounting policies, accounting for changes in estimates, and correction of prior period errors. It also establishes disclosure requirements that help users understand the effects of accounting changes on financial performance and position. Within the DIP-IFR syllabus, IAS 8 is important because financial statements often involve judgment, estimation, and evolving accounting practices. Proper application ensures transparency, faithful representation, and comparability across reporting periods and between different reporting entities operating under IFRS accounting standards. Certain items require separate disclosure in financial statements because of their significance, unusual nature, or impact on users' understanding of financial performance and position. IAS 8 requires disclosure of accounting policies relevant to understanding financial statements, especially those involving significant judgments or alternative accounting treatments. Material items such as changes in accounting policies, changes in accounting estimates, prior period errors, and unusual transactions must also be disclosed clearly. Required disclosures include the nature of changes, reasons for applying new policies, quantitative financial impacts, and adjustments affecting comparative information. Separate disclosure enhances transparency and allows stakeholders to evaluate how accounting decisions influence reported results. This requirement supports comparability and enables users to distinguish recurring operational performance from exceptional accounting adjustments or corrections. IAS 8 permits changes in accounting policies only under limited circumstances to preserve consistency in financial reporting. A change in accounting policy is justified when required by a new or revised IFRS accounting standard, or when the change results in financial statements providing more reliable and relevant information. Examples include adopting a new measurement basis or applying a revised presentation approach required by updated IFRS guidance. Voluntary changes motivated solely by management preference are not permitted unless they improve financial reporting quality significantly. When changes occur, entities generally apply them retrospectively, adjusting prior period comparatives as though the new policy had always been applied. This retrospective treatment strengthens comparability and helps users assess performance trends consistently across reporting periods. Prior period errors are omissions or misstatements in previously issued financial statements arising from failure to use reliable information available when those statements were prepared. Errors may result from mathematical mistakes, misapplication of accounting policies, fraud, oversight, or incorrect interpretation of facts. Examples include failing to record liabilities, incorrect depreciation calculations, or recognizing revenue improperly. IAS 8 distinguishes prior period errors from changes in estimates because errors reflect incorrect application of existing information rather than revised judgments based on new information. Accurate identification of prior period errors is important because uncorrected misstatements can distort profitability, asset values, and stakeholder assessments of financial performance and financial integrity within international reporting environments. IAS 8 requires material prior period errors to be corrected retrospectively by restating comparative amounts for prior periods presented in the financial statements. If the error occurred before the earliest comparative period presented, opening balances of assets, liabilities, and equity are adjusted accordingly. Retrospective correction ensures that financial statements reflect accurate historical information and prevents misleading trend analysis. In contrast, changes in accounting estimates are accounted for prospectively because they result from new information or developments rather than mistakes. Examples include revisions to useful lives, impairment estimates, or bad debt provisions. Prospective treatment affects current and future periods only, reflecting updated expectations without altering previously reported amounts. This distinction ensures consistency and faithful representation in financial reporting. Overall, IAS 8 provides a comprehensive framework for maintaining consistency, reliability, and transparency in financial statement preparation. By regulating accounting policies, changes in estimates, and correction of prior period errors, the standard enhances comparability across reporting periods and strengthens confidence in financial reporting. Separate disclosure requirements ensure that users understand the nature and impact of significant accounting decisions and corrections. Retrospective treatment of policy changes and errors preserves historical comparability, while prospective treatment of estimates reflects evolving economic circumstances appropriately. For DIP-IFR candidates, understanding IAS 8 is essential because accounting judgments, policy selection, and error correction significantly affect reported profitability, financial position, and stakeholder trust in international financial reporting practices governed by IFRS accounting standards.